Hi all, welcome to Free Float. I am Sham and I have Kishan with me.
Hey, Sham.
Today we are going to continue our discussion on momentum strategies. I will allow Kishan to sort of give you the intro and walk you through what we're going to discuss today. Kishan, take it away.
Yeah. So Sham, we have spoken about this many times. About momentum strategies, and I thought, a couple of weeks ago, we wrote about the risks or the downsides of like investing in like momentum. Because it's like the thing is the flavor of the season right now, and it might seem that we are against momentum, or we don't like momentum. In fact, me and you are big fans of it, and and but we think that our expectations. A is that I think it is important to have a long-term perspective when it comes to momentum, because you see years in between where you see 30% returns, maybe even like 100% return if it's like recovering from a large market drawdown. And then you see years in between when it underperforms continuously. We know that it would average out like over the long run. And when we average out, we don't mean it will average out at like 30% a year. We think it will average out, if it outperforms the benchmark for between 5 to 8%, annually over the long run, that we think is a great, return, because it's a very easy strategy to run, and 5 to 8% outperformance over the benchmark is a terrific return, and so we think about it like that you must have a long-term horizon, and you must know that returns will get normalized. It won't be 30% return, but you are looking at outperformance over the Nifty, and if you have a like even a single-digit outperformance, between 5 to 8%, that's pretty good. Even 3 to 5% is good, but 5 to 8% is really good. So one is that, because one of the risks that comes with momentum is if you invest in small caps, or in the smaller mid caps, you run the risk of liquidity. When markets turn, you are pretty much stuck, because a lot of stocks which go up because they are like operator driven, or there are very few hands chasing it, and when those hands want to exit, like in a stampede, the stocks are stuck in a downward freeze, and you can't get out, and you get through a lot of problems, and those stocks, and I mean small caps are more volatile than large caps anyhow, but you add that to momentum and liquidity, you're basically stuck holding. I would tell everyone just to stick to the higher the market cap, the better. And then I would the third thing that you should look at is asset allocation. Just the way we do it with Shark, Dolphin, based on your risk profile and stuff. Momentum makes sense for your portfolio, but if you hedge it against debt, or some other asset class, it would give you that drawdown, and that allows you to it is within your comfort zone, when those things happen, and you're not and you don't lose your sleep. And then the next is you hedge it against or you invest in different factors or different strategies where the risk and the source of returns and source of risk are to an extent diversified, right? And I think that's another way to do it, where you divide your portfolio up into value, quality, momentum, and your portfolio is somewhat less correlated to the Nifty, maybe not fully because it's still relative return, but the overall volatility in your portfolio, the overall beta risk in your portfolio, and that's another way of doing it. And yeah, and then the last way to do that, I guess, would be to chit with future options, which by knowing what you're doing, by not simply going and buying options, but by buying a put option, or buying or hedging or shorting Nifty and stuff, like blindly. It should be done with a proper strategy, and with I mean, you should know what you're doing, because doing that without understanding the risk and or like understanding the mechanisms of using derivatives, that can be a pretty much a double-edged sword.
Right. Yeah.
Okay.
Hey, so that's quite a bit to process, and I think people have the wrong idea as to what momentum does and what it doesn't. So first of all, momentum swings both ways. So you mentioned, like, over a long enough period of time, you should be happy with getting, say, maybe 5% over the benchmark. It's largely true. But the problem is momentum itself is extremely volatile, right? So what happens is, 1 year it'll swing, plus 100%. Next year it'll swing minus 50%, and so on. So for a real world investor, such a volatile portfolio, cannot be the only thing that that person invests in, right? So what if on the year that you're retiring, momentum decides to draw down 50%? So are you going to say, okay, I'll wait for another 20 years to retire so that I can, get to 5% spread? No, right? So, so it is always part of a larger group of strategies that you're running. And if you're an equity only investor, you have to focus more on allocation rather than getting carried away with just the returns angle of things. And by allocation, I mean just by even if you just keep your money in a bank FD, right? That is, you can treat that as your bond, so-called bond portfolio. And when you combine that with a reasonable momentum allocation, you will come out ahead with lower volatility and better returns than just buying the benchmark Nifty. There's no doubt about that. But the key is actually allocation. It is not anything else. And as an equity investor, hedging is meaningless to you. If you're a cash and carry equity investor, forget about hedging. It doesn't make any sense. So you can safely take that whole branch of Substacks and videos and all that and dump it into the ocean. It makes no difference to your life. So as an all cash investor investing in equities, focus on allocation. And whatever you do with momentum, know that the key thing there is sequence of return risk. You don't want to blow up, just before your retirement or when you want that money. So as you get closer to your goal, keep increasing the allocation to, risk-free safe assets. and that will take care of the rest. So when you're young, yeah, sure, you can have 80% of your portfolio in momentum, but as you get closer and more risk covers, make sure you're going away from it. Now, free float in that sense does that for you, right? So as your risk appetite changes, the allocation to bonds kind of change along with it, and the momentum part of the equity side of things, make sure that you're not compromising on returns. So it helps you kind of weather the storm when the storm does arrive in a cheap way. So a lot of other strategies involve trading, right? You need to trade the living daylights out of it, no matter what the market is doing, whether it is down 5% or 10%, you're still trading. And along with that, you have all the problems with slippages and so on and so forth. So given all the options available in front of an investor, focusing on allocation and making sure that your risk is aligned, with what the portfolio is able to deliver. What we've done with free float is, in my opinion, is probably the best step forward. Now, if you want to get a bit more, if you want to take a bit more risk, you can look at our All Stars portfolio, which does the trailing stop loss thing. But the thing is, it is still set up to be conservative. It favors large caps over mid caps and small caps. During the recent turmoil in the markets, when most momentum strategies bled about 5%, All Stars barely budged. It was kind of flat. So in terms of getting the balance between risk and returns, I think it does a fairly decent job. Now, these set of strategies should cover 90% of the investors out there, right? So if you need something more esoteric, then it should be something that is tailor-made for you. So you mentioned hedging, right? So hedging works if you're running a derivatives book, right? So if you're taking this momentum strategy and implementing it using futures, for example, right, then you can hedge that book with with some sort of market neutral strategy or a rupee neutral strategy or whatever, right? So you can hedge that, or you can build yourself a long short momentum strategy using using futures and design it to be market neutral. So those things can be done at a bespoke level based on how much capital you want to put at risk. But I feel that those are fringe cases, and for most investors, taking care of asset allocation is key. And I think right from the beginning of our free float series, we've been saying always focus on asset allocation. At the end of the day, that's what saves your ass, so to speak.
Yeah, and I think that can be that cannot be emphasized enough. If you're 30 and if you have the ability that you're not dependent on your portfolio, on the investment portfolio to live, and you should not be when you're doing that when you're 30. Then you should invest perhaps 100% of your money in your momentum portfolio, because even with even a 50% drawdown, you should have the ability to stomach it. But if you're 50 or 55 or 60, then definitely that's when I think the risk, the sequential risk and that asset allocation becomes tremendously important. I think and And like, even if you are, someone who can stomach short-term volatility, I think most people, do not want to see their portfolio go down by 50%, because that becomes very unpleasant. It becomes like, it becomes scary. So I don't think we would, I don't think me and you would advise anyone to invest on like a large percentage, unless you're 30 and you're looking at 30 hours, unless it's that kind of circumstance. We wouldn't invest. We wouldn't advise anyone to invest 100% in momentum, would we?
Not at all. So that's the thing, right? So if you listen to Taleb's strategy, right? So he basically says do a barbell. So on one end you have your high risk stuff that is going on, and on the other side you basically have US Treasury bills, right? So and the point at which you balance your barbell is your individual risk appetite. So you do need to have moonshots in your portfolio, just in case it does work out, then you make out like gangbusters. But at the same time, it makes no sense to risk ruin, so to speak, chasing only after those. So there is always this kind of temptation during bull markets. You kind of feel invincible because most people are have only looked at positive P&L, and most advisors kind of went live with the portfolios after the Corona meltdown, and all those portfolios look great. It is only when the storm arrives that you realize that it's always not this hunky-dory, right? There are a lot of names that I see now that are getting picked up by momentum portfolios that were getting picked up in 2017. The same players, right? The same guys, and again mooning. So you need to be careful because we obviously use stop losses and all that. So we're not going to risk ruin on that. But if you're one of those guys who are on a monthly rebalance or or a leisurely rebalance schedule or a discretionary, God forbid, discretionary momentum investor, then I would be very careful right now, because
with the kind of company.
Yeah, it's the kind of companies that are getting ramped higher. It's the same. I see parallels with the 2017, like all negative EPS.
Yeah.
And,
I mean, it's kind of deja vu, because I've been looking at markets since 2006, 2007, and it's the same story of mid caps. Mid caps go up. They, I mean, the characters might change, but it's the same behavior across these, these small bull runs that you have had since then, and always these stocks end up in ruins. After the great run they have, and it's always because something within the company comes out, like one of the companies, and then it knocks it knocks the entire space out. So I would agree with you that one of the things that that you should do is maybe have some kind of a quality filter, that there should be a reason why the stock is moving up. Like something should have changed in the company for the stock to suddenly spot up. I mean, the way it has, like something like either like it's growing at say double digits, and you believe the company is growing actually at those numbers, and it's not some like some smart thing that the company, like over smart thing the company is doing, or something has happened for it to go up. That should be a first check if you're doing some kind of I mean, that's one way of doing it, because then you're actually investing in companies which are going up, which have some fundamental basis.
I don't know, man. I tend to disagree with that, and I think we've had this disagreement before as well. I think quality is definitely in the eyes of the beholder, number one. So it's a very qualitative thing. And the second thing is fundamentals always lag price action. So the market kind of anticipates fundamentals to improve, and it ramps the price higher. So if you wait for fundamentals to catch up, you're always lagging the market, and sometimes it might the reverse might actually happen. So you wait for fundamentals to catch up, and then you buy the stock, and then the market decides, okay, this is it, it's all fully priced in, and exits. So so I would not do that. And also, the thing is, most of the stocks that are now getting picked up are all cyclical stocks. And most of them, tend to, kind of front run fundamentals. So I would not, wait for, fundamentals to catch up. And but I feel so. For example, right, you pay the piper no matter what. Okay, so the risk that you run flying so close to the sun is basically that you need to be very sort of risk averse when things when you feel things are going to turn. Okay, and the challenge is actually coding that up. So recently BSE did one ham-fisted press release, and it tanked a whole bunch of mid caps and small caps. So during that time, the momentum strategies that I run, all those Momo stuff, they went into like 50% cash, right? So so if you're running like 50 lakhs in the strategy, it means that in 2 days it sold 25 lakhs. Now, if the algo was indeed right, and this was indeed a turning point in the markets, then it saved your ass. And wave after wave of selling would have probably ensured in the next few weeks, and you'd be sitting pretty, probably 100% in cash. But the problem is that didn't happen, right? It was a fake. It was a fake sort of meltdown. So BSE released a correction, and market started reversed and started ramping higher again. So today, the portfolio is 90% in stocks, so 10% in cash. So my point is that all this trading activity is not free. So you pay the piper no matter what, and you have to be kind of in peace with it, because this is what you signed up for, right? If you don't do this, then the alternative is that you see like a 50% drawdown in your portfolio. So you pay the piper and be happy with it, and this sort of stuff happens. Like, there is no alternative to it. Somebody out there is making money off you sometimes. So
I mean, I think this discussion is like fascinating, like just applying momentum in different ways, and you're putting pros and cons about to each of the the different approaches that you can have. And I think it finally boils down to what kind of investor or trader you are.
Absolutely.
Or what you're comfortable with. I think that I mean, because a person might not have the time to do it on a day-to-day basis, and if he doesn't have the time, then if he doesn't execute strategy properly, then the 50% drawdown, the actual performance of if it tries to do it daily, the actual performance of it might be worse than him stomaching a 50% drawdown.
Yeah, it really depends, man, because there are quite a few people I've seen that they hold on to momentum stocks way beyond their expiry date,
Yeah.
waiting
I
for
know,
it
I
to
know.
turn around or whatever, right? So
Yeah, I've seen this so much.
yeah. So in my view, for me, it's absolutely essential that somebody just sells it off. And doesn't wait for me to give my valid or invalid inputs into, to throw that into the mix. So sometimes you're just wrong. You think something is a great value play, you expect a lot of good things going for the company, but the market doesn't believe in you, and it keeps falling. So in all these instances, automating the sell, on a brutal sort of price-based or a trend-based signal, saves you a lot of capital in the long run, because there is an opportunity cost to capital, right? So losing 50% means that 50% is not making you any money somewhere else. It's just in a stock, and you don't know when you will be able to exit, and for all you know, that stock might go to zero. Who the hell knows? So it is. So you can take that as something that can save your skin and deploy it somewhere else.
I agree with that. I mean, I think doing it discretionary.
Let me hang on a second. Right. So yeah, I think investors should also consider their opportunity costs, and not only look at buy and die kind of heroism. So
I think at the end of the day, I think like investing is very. To be successful in like investing, it should match your personality, and it should match.
Yeah. So most people like this slow moving stuff. They think they're, they have all this Warren Buffett quotes and everything saying, oh no, should not overtrade, should not use derivatives, should not do this. And then you have the exact opposite spectrum saying, risk hai to ishq hai. So let's let's roll the dice and figure out what it is. So you get all sorts. And the most important thing is to know who you are first, because the market has a way of digging that out of you. So if you are a faker, then you're not going to last too long. You will find out who you are.
Yeah, I can't agree more with that.
So I guess, with that, we'll wrap this up. So one last thing though, we spoke about momentum and hedging. So we do have a futures based momentum strategy that uses the same underlying funda of our all stars, and it is market neutral. So we've already rolled it out to a few select clients, and if you guys are interested, do drop us a note. The minimum capital requirement there is 25 lakhs. So to get started, so if it is something that would be of interest to you, give us a holler. So with that, thank you for watching. We'll see you again next weekend. Bye.
Sure. Thanks, P. Thank you.